Thank you for joining me on this video. My name is Rodney Constable. I am the president of Simple Market Signals at simplemarketsignals.com. In this video, we're going to be addressing the fallacy, or at least the huge misunderstanding when it comes to diversification with respect to equities. And so what we're looking at here is the S&P 500 as represented by SPY, which is the largest ETF in the space. We have the EEM, which is, and you can see the ticker symbols up here, the EEM, which is the Emerging Markets ETF. We have FXI, which tracks 25 of the largest capitalization companies in China. And then we have the MSCI World ex-US Index, which that's this one here, the pink looking bar. And that tracks over 1,000 holdings in 22 countries around the world and covers basically 85% of the market cap of the world outside of the U.S., okay? So what I want you to understand here, first off, this is a 5-day chart. So what we're looking at here is the relative performance of these 5 investments over the last 5 days. So as you can see here, yeah, the rest of the world down 2.84% in the last 5 days wasn't quite as bad as the S&P 500 down 4.25, but the point is that you're negative, right? There's, all of these things are hinged together. So what we're addressing here is diversification, but we're also addressing what's called systematic risk. And I really want to drive this point home, guys. It's so important to understand this because a lot of people will tell me, well, I'm diversified. I have holdings all over the world. Well, systematic risk, which is something hardly anybody talks about. And by the way, that's basically what my business, Simple Market Signals, deals with, okay? It's systematic risk because the game has changed. And what I mean by that is with ultra low bond yields around the world, high quality bonds are not in a position to offset equity risk like they used to, okay, 10, 12 years ago, and then prior to that. So we as investors and traders have to understand that diversification, and please understand this point, diversification reduces stock-specific risk, but it does not diversify away. You cannot diversify away systematic risk. So diversification cannot get rid of systematic risk. Systematic risk is the system. It's equities, and equities across the globe are, in my estimation, more highly correlated than ever before. The liquidity in markets is so great now, which is a good thing, but it also, and data goes across the world faster than ever before. So it makes everything flow pretty much in the same direction at the same time. Yes, perhaps at varying speeds, right? Again, over the last 5 days. And by the way, I'm making this chart before this video, before the market opens on Tuesday, February 25th, of 2020. So this is the last 5 days, including yesterday's big sell-off where the S&P 500 by itself was down 3.35% for the day, because I wanted to drive this point home, okay? So stick with me, though, because this is going to continue to be extremely educational, because I'm going to back up, look at different time frames, but I want you guys to understand that once you get beyond a certain amount of holdings, yes, you need diversification to reduce stock-specific risk. However, you cannot diversify away systematic risk. Systematic risk historically has been dealt with by building a portfolio, okay? And that's where you have, high-quality bonds, things like that to offset equity risk. That will still work to some degree, but with the 10-year Treasury now yielding under 1.4% as of yesterday, where a dozen years ago it was north of 5%. And keep in mind that 95+% of your bond returns are going to be found in the yield. So in other words, if a bond is yielding 1.5% and you hold it for, it's a 10-year bond and you hold it for 10 years, guess what your average annual return is going to be? About 1.5%. And by the way, that's taxable, okay? So just something to think about when it comes to bond returns. So again, this is why I believe that active management in going forward is going to be using something like my Simple Market Signals system, which is proprietary. It's mine. I'm the only person on the planet that has this. It works. And by the way, it's less than $20 a month, guys. It's super cheap, but it's effective. I built it for myself. I'm sharing it with you guys for less than $20 a month, all right? But just stay with me because you have to understand why this is so important. Whether you choose to work with me or not, that's entirely up to you, okay? But you need to understand this point. So let's back this up. So last 5 days, we know that across the world you'd have lost money, right? There's a little less loss here in the MSCI world if you were invested across the world than maybe in China or the emerging markets or the US. However, you're still down. So now let's back this up and let's look at the last month, all right? And you can see here that the S&P 500 is down 1.93%, again as represented by SPY, the ETF. The emerging markets ETF is down 6.57%. The FXI in China, the large cap, is down 4.3%, and you have the MSCI World ex-US Index down 4.13%. Let's back, and again, that's the last 21 trading days, so that represents the last month. And again, up here, and hopefully you guys are looking at this on a large screen, but you can see this is from the 24th of January through the 24th of February. Now let's back this up even further. Let's go to a 3-month view. And what you can see here is, and let's go right to left on this one. So the MSCI World ex-US Index is down about 0.2%, down 0.19. You've got the China large cap basically flat, down 0.06. You've got the EEM down 0.72. The S&P 500 is up 4.2. So again, you can see here that diversification has actually hurt you as you've moved away from the United States. I am not saying don't be diversified, but what I'm trying to do is educate you on the truth, on the facts, so you can make good decisions on your own, because diversification isn't what people think it is, okay? And understand something, guys. I've got a 20-year background in financial services. You know, at the peak of my career, I had 4 securities licenses, an insurance license, 5 industry designations. So I'm coming from a place of understanding the industry, and I want you to know the truth. There's nothing wrong with diversification, but what I have a problem with is people misunderstanding what diversification actually does and does not do. So and nobody is talking about systematic risk. And to me, it's a huge problem, okay? So the only way to really reduce systematic risk in the future is to lessen, in my estimation, you've got to increase cash. And with my experience, okay, you've got to increase your cash position and lower your equity position in times of higher volatility. That's going to be the best way, in my opinion, based on my research, my experience, my expertise. You make up your own mind. But based on my background and what I do, and I think you can see I'm a geek on this. I love this stuff. It's fun for me, okay? But I'm passionate about sharing this with you as well because I want you to succeed, with the facts. So let's go ahead and back this up. All right, so again, we're looking at the last 3 months here, and you can see, again, diversification didn't really help you there. And by the way, let me click over to this other screen because I want you to understand that I'm not cherry-picking these particular investments to show you. So what we're looking at here, I'm just going to kind of roll through this. This is just yesterday's returns, by the way, guys. So this is just for February 24th of 2020. But you see how everything was down. This is roughly 40 ETFs across the world that I track, okay? And this is just something that I put together that I track on a regular basis. The only thing that had a slightly positive return yesterday was the US dollar, okay? So you see these areas where the UUP, again, the dollar index is not investable. The UUP is the ETF that tracks the dollar, the US dollar. It was up 0.04% yesterday. Everything else was down. So you can see diversification. These are 40 ETFs across the world, and everything was down. Okay, so let's back this up for a week so you can kind of see what I'm looking at. Again, there's a few things that are up slightly, but you can see that everything this last week is down. Okay, and I'm going to show you this because this is going to blow your mind. This ASHR, this ETF, it's a China 300. It tracks companies in China. It's the best. I mean, here we are dealing with the coronavirus, and this particular investment is the best of what's across the world over the last week. So, and China is really up at the epicenter of the coronavirus. So again, I was surprised to see that. But I hope you're seeing the point here that diversification does not reduce systematic risk. Diversification reduces stock-specific risk. Okay, so let me give you an example. So let's say you have two stocks. And I'm not trying to, with any of these, I am not making recommendations to go into any of these investments. I'm trying to educate you on how this stuff works, okay? But let's say you have Apple, and the only stock you own is Apple, all right? That's it. It's been a great stock as of late, right? And definitely over the last 15 or so years. But the point is that you've got a ton of exposure to that one company. But now if you buy Microsoft and you have 50% of your portfolio in Apple and 50% in Microsoft, now you have some diversification, okay? They're both still tech stocks, but you have less stock-specific risk. And then if you add, another stock to it and another stock to it, another stock to it, you start to reduce your stock-specific risk to each one of those holdings as you reduce the percentage of your portfolio in each stock. But they're all equities. They're all tied to this system. Now, back over here to this. Again, we're looking at the past 3 months here. Let's go back 6 months. And again, you can see that the S&P 500 has soundly outperformed and in a lot of cases doubled what the rest of the world has done. So again, diversification internationally. I've heard talking heads on, the financial shows. Oh, you got to invest, in the emerging markets or whatever. Well, again, please don't misunderstand my message here. I'm not saying that's not a good idea, but you've cut your returns by doing so. All right. And again, I'm not trying to say invest everything in the S&P 500. However, a lot of people are doing that, but I'm just trying to get the point across that diversification doesn't do what a lot of people thinks it does. Okay, that probably wasn't the best sentence. Any of you English majors out there, so forgive me, but I'm trying to drive the point home here. All right, and again, over the last 253 trading days, okay, rolling back one rolling year, you can see the SPY, even after this last sell-off, is up 17.69%. You have the EEM, the emerging markets, is basically flat, down 0.36. You have the China large cap down 5.5%, and you have the MSCI World ex-US Index, so again, ex-US meaning it doesn't have any US holdings in it, up 4.88% during this same time frame. So, guys, I hope this has been helpful and beneficial, and I hope you understand at least a little bit more now and have more realistic expectations that the answer to returns isn't necessarily diversification, okay? Diversification can help you or it can hurt you. If you're invested in all of these, let's say you had 25% of your portfolio in each one of these holdings, you could see that it actually hurt you over this last year because this, in the example that you have 25% invested in each one of these holdings, 25% of your portfolio was up, the most. And then you had another 25% in this example, right, hypothetical, that was up less than 5%. And then you had the other part of your portfolio that was negative. So, it's not about necessarily diversification. It's understanding how these things actually work. And let's just for fun, before I let you go here, let's back this up. All right, let's just go back a ways, and so you can kind of see as I'm backing this up. Now we're back into September of 15. I'm just going to keep backing this thing up here, so you guys can kind of see, that investing in these other holdings hasn't necessarily helped your returns. Okay, here we're back well over 1,300 trading days, right? And as we go back. Here we are. Let's go back, as a matter of fact. Let's go back to, let's see if we can go back to like March 9th of 09, which is, if I get this thing positioned correctly, March 9th of 09 was when the recent secular bull market started. And what you can see here, guys, is, so now we're looking at March 9th of 09 through the 24th of February of 2020. So basically, this is the entire secular just meaning long-term, bull, and secular also with respect to bull markets means the price-to-earnings ratios are expanding, okay? So you've got increasing earnings and price-to-earnings ratios expanding. That is the definition of a secular bull market. But look at this. The S&P 500 is up 491.57%. Okay, almost 500%. You've got EEM up 152.28. You've got FXI up 122.97. And the MSCI World ex-US Index up 114.77%. So the question becomes, how much did diversification help you here? So I hope, again, this has been insightful, helpful, and I hope you guys understand that at least a little bit more about the fact that diversification doesn't necessarily help your performance of your portfolio. It can dampen in some respects, okay? It can dampen the volatility, right? Especially with stock-specific volatility. But once you get, there's 500 holdings in the S&P 500, and 50% of the earnings of the S&P 500 come from outside of the United States. So, guys, even though they're domiciled, these companies are domiciled here in the U.S. with respect to the S&P 500, there's a ton of diversification as far as where they get their earnings and their revenue. Over 50% comes from outside of the U.S. All right. So, for most people, and again, I am not making a recommendation here. Okay. You have to do what's right for you. But I'm just trying to point out the facts. For most people, and statistics show this to be the case, right? More and more people are indexing, and there's nothing wrong with that. But you just have to understand, in my opinion, there's nothing wrong with that. For a lot of people, it's going to work. But you then need to understand, what is your risk in being an investor, a holder of the S&P 500? And your biggest risk is systematic risk. And systematic risk cannot be diversified away. Hopefully that was helpful. And again, Simple Market Signals, my company, this is what we deal with, is systematic risk. So I would encourage you to maybe spend a few minutes investing in yourself to find out a little bit more about Simple Market Signals and what we do. Thanks for watching this video. I'll see you in the next video. If you would like to learn how Simple Market Signals can help you become a more successful investor, trader, or financial advisor, you will want to watch the video introducing Simple Market Signals, which is on my YouTube channel. I will also leave a link to that video in the description box below this video. Thank you for watching. Don't forget to subscribe, and please give me a thumbs up on this video, leave a comment, and I look forward to seeing you in the next video.